Warren Buffett's warning: get out. When Warren Buffett speaks, the world listens. The legendary investor, known for his measured approach to finance, has offered countless nuggets of wisdom over the years. But when Buffett issues a warning, especially one as stark as get out, it's time to take notice. Let's dive into the deeper meaning of Buffett's cautionary message, its implications for investors, and how you can position yourself to navigate turbulent economic waters. Understanding Buffett's warning. Buffett's statements, while often concise, are deeply rooted in his experience and analysis of the financial markets. When he warns investors to get out, he's not advocating for panic. Instead, he's highlighting specific risks in the market, risks that, if ignored, could lead to significant financial losses. Buffett's warnings typically focus on overvalued markets, speculative behaviors, or unsustainable economic trends. With stock markets experiencing record highs in recent years, fueled by easy monetary policies and a flood of retail investors, it's no surprise that Buffett's message resonates now more than ever. The signs Buffett watches for. Buffett has consistently emphasized a few key indicators that signal trouble ahead. Let's break them down. 1. Market overvaluation. Buffett's favorite measure, the Buffett indicator, compares the total market capitalization of U.S. stocks to the country's GDP. Historically, when this ratio exceeds 100%, the market is considered overvalued. In recent years, this metric has soared well beyond historical norms, signaling potential overexuberance. 2. Speculative frenzy. The Oracle of Omaha has warned against the dangers of speculative bubbles, where prices are driven not by fundamentals, but by greed and fear of missing out, FOMO. The rise of meme stocks, cryptocurrencies, and unprecedented retail trading activity are red flags that Buffett's cautious approach seeks to avoid. 3. Rising interest rates. Buffett understands the profound impact of interest rates on the economy and the stock market. With central banks signaling tighter monetary policies, higher rates could pressure overvalued assets, leading to sharp corrections. 4. Unsustainable debt levels. Both consumer and government debt have reached alarming levels in many economies. Buffett has frequently pointed out that high debt levels can make economies vulnerable to shocks, potentially leading to prolonged downturns. Lessons from Buffett's past warnings. Buffett's warnings are not new, nor are they baseless. Examining past instances where he raised alarm bells can provide valuable insights. Dot-com bubble, late 1990s. Buffett famously stayed out of the dot-com craze, warning that many tech companies lacked sustainable business models. When the bubble burst in 2000, his cautious stance proved correct, saving Berkshire Hathaway from massive losses. 2008 financial crisis. While Buffett didn't predict the exact timing of the 2008 crash, he frequently warned about the risks of excessive leverage and complex financial instruments. During the crisis, Buffett's preparedness allowed him to make lucrative investments in companies like Goldman Sachs and General Electric. COVID-19 pandemic, 2020. In early 2020, Buffett sold significant holdings in airline stocks, citing uncertainty about the industry's future. While some criticized the decision, it highlighted his ability to pivot when circumstances changed dramatically. What does get out mean for investors? When Warren Buffett warns investors to get out, it's not a call for panic, but a reminder to exercise caution and reassess your approach. The phrase underscores the importance of understanding market risks and positioning yourself wisely amid potential turbulence. Let's break down what this warning means for investors and how you can respond. Avoid speculative investments. Buffett's advice often centers on steering clear of speculative assets driven by hype rather than fundamentals. Cryptocurrencies, meme stocks, and other high-risk investments may promise quick profits, but often lack the stability needed for long-term success. Get out could mean reducing exposure to such volatile holdings. Reevaluate your portfolio. Take Buffett's warning as an opportunity to reassess your portfolio. Are you overly concentrated in high-risk sectors or overvalued stocks? Diversifying your investments across asset classes and industries can help mitigate risks and provide a more stable foundation for growth. Prioritize quality and value. Buffett is a staunch advocate of value investing, Focus on companies with strong financials, a durable competitive advantage, and a track record of consistent performance. Selling overvalued or speculative positions and reallocating to high-quality investments can better align your portfolio with Buffett's philosophy. Stay patient and disciplined. Get out doesn't mean abandoning the market altogether. Instead, it's a call to be patient and avoid impulsive decisions. Maintain a long-term perspective and stick to your investment plan, even during periods of uncertainty. Prepare for opportunities. Holding cash or liquid assets can position you to take advantage of opportunities when markets correct. Buffett himself emphasizes the importance of liquidity during turbulent times. Ultimately, Get Out is a reminder to stay vigilant, invest prudently, and focus on long-term financial health. By heeding this warning, you can better navigate market challenges and secure your financial future. How to apply Buffett's wisdom in today's market. Buffett's strategies are timeless. Here's how you can apply his wisdom in the current economic environment. 1. Invest in what you understand. Buffett's golden rule is to never invest in businesses you don't understand. This principle is especially relevant in today's complex financial landscape, where new technologies and trends dominate headlines. 2. Focus on long-term growth. Buffett's success stems from his ability to think long-term. Avoid getting caught up in short-term market swings and focus on investments that align with your financial goals. 3. Monitor economic trends. Keep an eye on macroeconomic indicators such as inflation, interest rates, and GDP growth. These factors influence market performance and can guide your investment decisions. 4. Stay patient. Buffett often emphasizes the importance of patience. In his words, the stock market is a device for transferring money from the impatient to the patient. Avoid impulsive decisions and stick to a well-thought-out plan. What could Buffett's Get Out signal mean for the economy? Buffett's warning is not just about individual investments, but also reflects concerns about broader economic stability. Here are a few potential scenarios. 1. Market correction. If markets are overvalued, a correction could bring prices back in line with fundamentals. While painful in the short term, corrections are a normal part of market cycles. 2. Recession risks. Buffett's caution may stem from concerns about an impending recession, driven by rising interest rates, high inflation, or geopolitical tensions. 3. Shifting investment landscape. Buffett's warning could signal a broader shift in market dynamics, such as a move away from growth stocks to value stocks, or increased demand for defensive assets like bonds and gold. Conclusion. Heeding Buffett's advice. Warren Buffett's warning to get out is not a call to panic, but a reminder to invest wisely. His message emphasizes the importance of avoiding speculation, prioritizing value, and staying disciplined in uncertain times. By applying Buffett's principles, you can navigate market volatility with confidence and build a portfolio designed for long-term success. Remember, Buffett's advice is rooted in decades of experience and a deep understanding of market dynamics. Take his warning seriously, reassess your investment strategy, and position yourself to weather whatever challenges lie ahead. The goal is not just to survive, but to thrive in an ever-changing financial landscape.